Hi, Kristen Cooper, your mortgage gal here. Super excited to go over this information with you. I have a lot of questions around should I buy when interest rates are a little bit more elevated than where they're going to be in the next couple of years, or should I wait until interest rates come down? And what are some different options and strategies for me to be able to afford a home in this market? So around that, there's really a lot of different things that we have to consider. One of the biggest things is depending on the market that you're purchasing in, typically when interest rates are higher, there's more room for negotiations. And so being able to use that as a strategy to save you more money is really what the objective is. And so what we're going to look at is one of the many strategies that we have to be able to make a housing payment more affordable so that you can purchase in the market today. If you look at rent versus buying, which I have many videos that you can search on my YouTube and be able to look at that, it shows you that if you're able to afford a mortgage in today's market and purchase, then you're going to have massive amount of net worth that you're going to gain by buying today versus waiting. So really the topic becomes, how can I find a affordable mortgage strategy in today's market to where I could take advantage of being able to invest to get that return? And that's what we're looking at. So there's different strategies that we have depending on the home as well as the flexibility for negotiations. But let's just assume that we find a property, we're in a market where we can negotiate and potentially get a seller credit, or we can use some of the funds that you have to get a lower interest rate to make the payment more affordable. So we're going to look at pros and cons to all those options. There's many more options that we can consider, but specifically today we're going to look at permanent rate buy down versus temporary rate buy down, and what does that look like and what does it even mean? So first we're going to look at what's called a permanent rate buy down option. What that means is that there is money that's used, whether it's a credit from the seller or your funds, that we use towards buying down the interest rate. Now, mortgage interest rates kind of work in a rate card, meaning that you get to decide your rate. You can go with the higher rate, have lower cost. You can go with the lower rate and have more cost. So you're paying a fee to get a lower rate. Now, the benefit of doing that is a lower rate means a lower payment. So if we're able to get the seller to pay for that, there's no more additional money that comes out of your pocket. Or if you have money available, we may use some of your money to buy down the rate versus putting it as a down payment. So my job is to be able to show you those options to find out what's most cost effective for you based on your goals moving forward. So if we're looking at a permanent buy down, what that means is that you pay a fee to permanently get a rate for a specific amount of time, depending on how that is. So if we're looking at a 30-year fixed rate mortgage, you're paying a fee to get the lower rate for the entire 30-year fixed rate mortgage. It's permanent, meaning that you pay the fee and then going forward you have that rate. Now with a permanent buy down, once you pay that fee, that money's gone, meaning that if you had this loan for only 1 year, you don't get any of that money back. So once you've paid that fee for however long you have the loan, you get the benefit of that lower rate. So what we're looking at in those structures is, how do we negotiate this with the seller? And this is why it's really important that you're working with the right mortgage and real estate team to work together to get you all of these options. But to keep it simplistic, let's say that you found a price home at $549,900. You're putting 20% down. Let's say the rate is 7.125. Well, then that means that your payment roughly that you're going to be looking at, including the property taxes and insurance, we'll call it $35.93. Now you say, there's this home, we think that the seller is willing to negotiate. What do we do? So let's say that the seller, your agent says, I think that we can probably get a credit of $10,500. How do we use that $10,500 to get the best use of the funds? Now we can do a price reduction. So you can say, hey, I would just want to go ahead and ask for that $10,500 lower price and pay less for the home. So you can absolutely do that. Now you pay $539,400 for the home, of course, same rate. And now you could see that your monthly payment now goes from the $35.93 to the $35.26 because now it's reduced in price of what you're looking at. So great, now you did the price reduction, you have the lower payment. But what other options could we explore if affordability is what's really important? If you look at it and you say, okay, well, let's go ahead and do the same price. So let's do the $549, but let's use that $10,500 to get to a lower rate. So now let's say that we could get you to a 6.375. Well, now your payment's only $33.74. So it's the same $10,500 that the seller is giving you, but instead of asking for less in price, we apply that to getting a lower rate. And you can see there how big of a change that is to your payment. So instead of you having a $35.26 payment, if you did the price reduction, now you have $33.74. So this is another way where if you found a home, originally your payment was going to be $35.93, and just by getting them to give you a credit of $10,500 or allocating funds you have, we could potentially get you to $33.74. And again, that's for the entire 30-year fixed rate. Now, the other thing that we have to consider is in order to get that same payment. So if we said, you know what, no, we want to do a price reduction, but we want that payment of $33.74. Well, now you're going to have to do a price reduction, meaning that you're going to have to tell that seller, instead of paying $549,900, I want to pay $509,230. So I need you to reduce your price almost $40,000 to get that same payment. So this is where it's really impactful in being able to know where to allocate the funds depending on your overall goal and objective of what's going to be best for you moving forward, because you can go into a seller and just ask for a $10,500 credit and get a $3,374 payment, $3,374 payment, versus you would have to go in and find a home at $509. Well, what's really impactful about that is you can walk into a home at $509, let's just say that's the value of the home, $509, to get that payment, and it's going to be a big difference from this home that's $549. So understanding the ways that we can use the funds and the credits to get you the most affordable payment is super important. The other thing that we want to consider when we're looking at credits is what's called a temporary buy down. A temporary buy down is just that, to where depending on which option we look at, and we're going to explore several, but depending on how much time we're looking to do a temporary buy down will depend on how much of a credit we're going to need from the seller or how we need to structure our financing in order to make that happen. But there's pros and cons to both. Permanent rate buy down obviously is great because you have that permanent rate buy down for 30 years. So depending on the market that you're doing it, that might be the right option. But we're in a market where interest rates are going to end up getting lower in the next couple of years. It doesn't really make sense most of the time to do a permanent buy down, and this is why. So when we're in a market where we are today, where we have a little bit more elevated rates, but they're in the trajectory of coming down in the next couple of years, a temporary buy down is a great strategy that saves you a lot more money, and here's why. So let's say that in this scenario, we find a home, same thing, $549,000. You can see the interest rate is 7.125. Your payment's $35.93, and we say, you know what, Kristen, I think I really like this home, but I don't want that payment. That's higher than what I'm comfortable with being able to afford. What are the best options? So this is specifically called a 2-1 buy down. So what that means is that with the credit that we would get to be able to pay to do this, the interest rate is 2% less the first year. So for the first 12 months, you're only going to be paying 5.125. The second year, it goes up to 6.125. And then the third year, and then every year going forward, you're now at that 7.125. Why this is a great strategy is because when interest rates are going to be coming down, which the Fed's number one focus right now is getting inflation to come down, and interest rates are directly correlated to inflation, meaning if you look at history, every single time that inflation comes down, interest rates come with it. We know interest rates are going to go down. It's just a matter of when are they going to come down. So there are some people saying short term, hey, we can get you into a loan and refinance in a year. I don't think that that's necessarily going to be the case. Could it happen? Sure. But I'm always going to be conservative and say, let's look at next 2 years or so that you potentially could be having this loan before we put you in a lower rate. I do think that we're going to have an opportunity to kind of go downstairs, meaning get you, into lower rates along the way as they go down. And it's really important that you're working with the right team that's going to save you money through that, not cost you more. There's a lot of different people that you could talk to where they say, let's get you refinance. You pay a lot in fees for the savings, you don't make it back. So you want to make sure you're working with someone that is trust, integrity, doing the right thing for you and saving you money before you do that refinance, which means paying off the current loan and getting a new loan in the future. Also, you get a discount as a client of mine coming back because I don't believe in charging you the same for a purchase versus a future refinance and want to save you the money. So we can look at doing a no cost refinance in the future when rates drop, and then again you'll probably do another one in the future so that we're not costing you more money. But if we look at this strategy, what's great about it is that you know exactly what to expect. This is not an adjustable rate mortgage. The rate, you know exactly where it's going to be. As soon as it closes, year one, your payment's going to be that $3,025. Year two, your payment's going to go to $3,302. And then year three, and then every year that you have the loan going forward now is $3,593. So after that third year, that's your payment. You know what to expect. The likelihood that we're going to be putting you into a lower interest rate before then is very likely. And so this gives you protection of that 3-year window. But worst case scenario, you know exactly what to expect beyond that. So you're not going to be shocked or surprised if something happens that we didn't expect. None of us have a crystal ball. And we didn't expect COVID when it happened. So you just never know, but you know exactly where your payment's going to be. It also allows for several years for your income to go up at work. And be able to adjust, pay off debts, things like that to free up more income so that you can get into a position to be able to afford it. So that's why I love this strategy, is that you know exactly what to expect. And instead of having that $3,600 payment from day one, it helps you transition into being able to afford it. Not only that, but it's going to get you into a home that you love and want more, that you're probably going to have a higher rate of appreciation on because it's a nicer home and maybe doesn't need as much updates to the home and gets you into the area, school district, all of those things. So you're not having to compromise what you need in a home, but you are getting the ability to be able to pay a lower payment and then go into a future payment moving forward. So what we're going to look at here is what's called the buy down strategy. So when we went over the 3-2-1, meaning you get the lower interest rate, well, how does that happen? So what we're looking at here, the one that we were just looking at is the 2-1 buy down strategy, which means year one, like I showed you there, you can get an interest rate of 5.125, year two 6.125, and then year three going forward, again, we're at that 7.125, which is current market rate. So how the buy down works is called a subsidy. So what that means is that the difference from what your payment will be at the 7.125, which is the actual rate for today, and the discounted rate, that's called a subsidy, meaning that somebody's paying for that. Typically, we get a seller credit if possible, and the seller is paying for you to have the lower payment each year. So that would be the amount that we would need in a credit. So you can see year one here. Note rate payment, the actual would be $3,061, and that's your principal and interest. It doesn't include the taxes and insurance. And then the buy down payment would be $2,447. So what that means is what I just showed you in the last numbers for the payment is year one, your payment's going to be $568.51 less than what it would be at current market rate. So that equates to $6,822.12. The second year, it's going to be $290 less, which equates to $3,489.84. So these 2 years, it will cost $10,311.96 in order to have the lower payment options. So that's what we would be requesting in a seller credit in this specific scenario. Now, as you can see here, we have many buy down options. My goal as your mortgage advisor is to look at the wealth based on your goals of what you're trying to accomplish and figure out what's going to be the best strategy for you. We can potentially even look at a 3-2-1 buy down, which just gives you more time at a lower payment, but it does require a higher credit, which may or may not be an option for you depending on the market as well as the property that you're looking at. And then we have some additional smaller ones, so we can have a lower payment for 1 year, a lower payment for 2 years, which are more affordable options. So I think it's really important just to know that you have options when it comes to getting a more affordable mortgage in the market and that you're working with the right team. The other benefit of a temporary buy down versus a permanent buy down is that when it's a subsidy, meaning that you are having the seller pay for the difference in payment, that subsidy, whatever you don't use, is going to be credited towards your payoff whenever we get you a new loan. So what does that mean? So in this scenario, let's say that there's, you got a $10,311 credit from the seller for the 2 years. Let's say that at the 12th year, you make that 12th payment and we pay off this loan because interest rates got lower. We pay off that loan and get you a new loan. Well, now this $3,489 that you did not use is your money. It's not lost money. That money will be credited towards your payoff at closing and your new loan. So it's really great because you get that money. You don't lose it versus a permanent buy down, which is what we went over initially, meaning that you pay a one fee to get a lower rate and then you refinance in a year, you don't get any of that money back. So you end up losing money. So it's really important to understand your strategies that are available in this market, that you're working with the right team to make sure that you're getting the best options available in this market to help find a affordable mortgage to save you so much money long term and be able to use that money for your future. So it's really important. I mean, we all know rent versus own, where, if you're paying rent today, and this is just assuming $3,000, every year that you wait, obviously that $3,000, that's $36,000 a year that you're paying on rent that you have no return on. So I can't stress it enough that it's really important for you to put yourself in a position that you're starting to invest. And this is where I have conversations with young adults. The sooner you can start, the better. And we look at compound interest and that over time, the same thing with appreciation and paying down your principal. The sooner you can start investing into your net worth, the greater the return. And being able to do it in this market is huge. So even if that means that you're a first-time home buyer and you're, maybe a little bit worried about the payment, maybe you can rent out a room to be able to help offset it for the first couple of years until you get into a position where you feel more comfortable. A lot of options available to be able to look at you starting to build your wealth. I'm trying to get in front of as many people as quick as possible so that you can start building this for your future, for your family, and start creating the wealth for yourself. So please give me a call. I'd love to look over the different options for you so that you know what are the strategies in today's market to help you win.